Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of New York and London sugar markets. I'll start with ICE raw sugar in New York. Now, it's headache time again, though slightly less thumping than last week. I again must apologize for the multitude of lines and labels that I've drawn and have kept on this daily chart. However, technically there's still, again, a lot going on here, and these labels and lines are all valid in my deciphering, trying to decipher what is happening here. Okay, so instead of giving a huge history on this, I'll instead talk about the action from the peak in May and reference earlier pieces as I deem necessary. The market's rise in May was up to the neckline of the August to November 2021 complex triple top, currently at 2051. Breaching it ever so slightly before the rally failed, and we've seen prices drop, gapping lower even. The mess of congestion support we'd seen around the middle time of December 2020 to April 2021 bullish shift pitchfork, currently at 1932, mainly the combination of the February 2021 high at 1894, the medium moving average, currently 1908, the long moving average, currently 1911, and the short medium moving average, currently 1898. Well, they eroded the bearishness on the way down from the start of May until the middle of the month, such that though prices pushed below all of them, the market did not have the immediate energy to aggressively push any further lower. For instance, we did have support below this congestion with another congestion area dating from February this year between approximately 1840 and 18 even. However, last week and late the week before, the market tested down and through this area, all the way down to breach the lower time, currently 1783, of the recent April to May bearish shift pitchfork. Though the market did not break it, as the fall only extended down to the 50% Fibonacci line of the March-November 21 move at 1768 before prices turned back up again. This 50% Fibonacci line has been very influential as it had stopped declines earlier in January, February and March as well. These two supports, the declining lower time and the 50% Fibonacci line, turned prices back up with such vehemence that by last Friday prices were once again testing the declining short-medium moving average, currently 1898, the slowly rising medium moving average, currently 1908, and the flatlining long moving average, currently 1911, but only managing to close over the short-medium moving average. However, more importantly, the market made a weekly key reversal up last week. Support for this move is now from the February 2021 low at 1894, and perhaps more importantly from the declining middle time, currently 1882, of the same bearish shift pitchfork that saw the lower time being tested only last week. Yet, on the bigger picture, the really bigger picture, we haven't seen a move as such. The market is still in between the overhead middle time of the big December 2020 to April 2021 bullish shift pitchfork, currently at 1932, and the lower time below, currently 1707. You see, this pitchfork is also still valid. So at the same time, the bigger picture is still a slowly rising bullish shift pitchfork, while the more recent move is a bounce up within a smaller bearish shift pitchfork. Well, such a situation cannot last. One of these two will have to give way. ICE Europe white sugar in London. The rise we saw late May going into June started to be corralled on the top side, for the most part, by the middle time, currently 608.60, of the February to May breached and maybe broken bullish Andrews pitchfork. The rest of the heavy work of resistance was made up by the upper time, currently 608.5 of the bullish shift pitchfork, for the same move as the bullish Andrews pitchfork. Remember, these two pitchfork tines, remember them, as they will come up again later. There were also banded resistances that helped cap the rise, starting at 587.10 all the way up to 608.30, and including the November 2016 high at 590 and the October 2016 high at 608.30. This congestion was too much for the bullish incentive, and 5 weeks ago the market made a weekly key reversal down in response. Then 4 weeks ago the market went through a period of indecision, caught between roughly 555 even below and 570 above. On Tuesday 3 weeks ago, the market made up its mind and dropped down through the base of its congestion as well as the middle time, currently 569.80, of the shallower bullish shift pitch fork, for the same move as the bullish Andrews pitch fork, plus the lower time, currently 563 even, of the more acute bullish Andrews pitch fork. Hence we arrived at the period when it is debatable as to whether the market broke the bullish Andrews pitch fork or merely breached it. Now I am minded for the moment to regard it as having been breached rather than broken, despite the pair of consecutive closes, in one case 4 consecutive closes, underneath. You see, there were 3 things that supported the market. Firstly, the aversion of prices to push and test the rising medium moving average below, currently at 541.30. Secondly, the breached but still strong support of the short medium moving average, currently 550.20, and the March 2017 high of 548.70. Finally, the third one, there was the lower time itself. It played a role in dragging up rather than pushing up this market back higher. All this action has set aside the chances for the market reaching down to target X in the 528 even area. This was the target for the action over June, being a version of a bearish halfway hesitation. This will be retired after this commentary. Now, what I would like you to know are the 2 round circles on the daily chart, which they indicate 2 dates when the tines of the bullish Andrews and shift pitchforks cross over. Now, the first one is partially obscured, but it is also today. Yes, today, the 11th of July. The second is on Friday, the 22nd of July. Now, what to expect? Well, look for one or more of the following possible actions: volatility, a change in trend, and or a reinforcement of trend. This usually happens when the tides cross over or soon thereafter, hence the circles and the caution. I suppose this goes some way to explaining the wide range you'll see today. It nevertheless gives notice of another potential volatile day, only about 2 weeks hence. Sugar white premium spread. After recently reaching the topside target for the problematic bullish ascending wedge pattern formed between June last year and March this year, the market looked to move back down. However, once reaching the middle time, currently 140.75 of the huge 2019 to 2021 bullish Andrews pitch fork, prices turned back up again with an immediate countering bullish piercing line pattern and bullish double 2 weeks ago. This is important as the only pattern still left standing is this 2019 to 2021 bullish Andrews pitch fork. However, though last week prices did indeed make a new recent high, they are eroded in their attempt higher by the same overhead congestions at 152.75 on a closing basis, and as regular resistances at 162.75, 164.75, 173.75, 175 even, and 178.5. Nevertheless, prices have now seemingly established themselves over the middle time, and this week have so far started to build a bullish pattern, which isn't the hardest thing to do, given that last week was an indecisive spinning top. So the primary target for the ascending wedge pattern was achieved a few weeks ago. We still have the secondary, harder to achieve target X1 for this pattern, higher up in the 191.5 area, and just off the top of my daily chart. Finally, I added the following comments a few weeks ago, and I quote, "I know that these are humongously big asks, but that is what I see. It depends on one thing, and one thing only, that prices maintain contact with the middle time or break upwards clear of it." End of quote. Well, so far prices have broken up through the middle time and seemingly consolidated. It's now up to them to show whether prices have the capability to reach target X1. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.